The Intelligent Investor Summary can help you unleash your investing potential with timeless wisdom. Navigate markets confidently, guided by proven strategies. Unlock financial success with the power of informed decisions. Transform your approach to wealth creation and embrace prosperity. This book is a comprehensive guide for both defensive and enterprising investors, offering practical advice on stock selection, portfolio management, understanding market fluctuations, and establishing a successful investment philosophy. Chapter 1: Investment versus Speculation. Graham begins by distinguishing between investment and speculation, emphasizing the need for a disciplined approach to investing. He advises against being swayed by short-term market fluctuations and instead advocates for thorough research and analysis before making investment decisions. For example, investing in a company with a strong balance sheet, consistent earnings, and a history of paying dividends can be considered an investment, while speculating on stocks based on rumors or market trends is speculative and risky. Chapter 2: The Investor and Inflation. Graham explores the impact of inflation on investments. He advises investors to consider the effects of inflation when making investment decisions and suggests seeking assets that provide protection against inflation. For instance, investing in stocks of companies with strong competitive positions or real estate properties that tend to appreciate with inflation can help preserve purchasing power over time. Chapter 3: A Century of Stock Market History, the Level of Stock Prices in Early 1972. Graham provides a historical perspective on stock market trends until the early 1970s. He warns about market fluctuations and advises investors to evaluate stock prices relative to fundamental factors rather than being solely driven by market sentiment. Graham explains that market booms can lead to overvalued stocks, where prices exceed the intrinsic value of the underlying companies. This can pose risks for investors. He highlights the importance of analyzing a company's financials, understanding its competitive position, and assessing its growth potential. Chapter 4: General Portfolio Policy, the Defensive Investor. Graham introduces the concept of the defensive investor, who focuses on minimizing risks and seeking reasonable returns. He suggests diversifying a portfolio by including both stocks and bonds. For the defensive investor, selecting well-established companies with a history of stable earnings and dividends is crucial. By diversifying across different asset classes and industries, investors can reduce risks while seeking steady returns. Graham emphasizes the importance of a conservative and disciplined approach to investing. Chapter 5: The Defensive Investor and Common Stocks. Building upon the previous chapter, Graham explores the role of common stocks in the portfolio of a defensive investor. He advises defensive investors to focus on large, well-established companies with stable earnings and a history of consistent dividend payments. Graham recommends investing in stocks that have a track record of weathering economic downturns and maintaining profitability. He suggests evaluating key financial ratios such as price-to-earnings ratio, dividend yield, and price-to-book value to identify attractive investment opportunities. Chapter 6: Portfolio Policy for the Enterprising Investor, Negative Approach. Graham discusses portfolio policy for the enterprising investor, who is willing to put more effort into their investment activities. He introduces a negative approach that involves actively eliminating unsuitable securities from consideration. The enterprising investor focuses on excluding companies with excessive debt, poor management, or unfavorable market conditions. Graham emphasizes the importance of thorough analysis and avoiding speculative investments. Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. Graham explores the positive side of portfolio policy for the enterprising investor. He suggests looking for bargain stocks, special situations, and other investment opportunities that may not meet the criteria of defensive investing. The enterprising investor conducts thorough research and analysis to identify undervalued securities with the potential for significant growth. Graham provides examples of special situations, such as stocks of companies involved in mergers, acquisitions, or restructurings, that can present attractive investment opportunities for enterprising investors. Chapter 8: The Investor and Market Fluctuations. In this chapter, Graham emphasizes the importance of taking advantage of market fluctuations rather than being swayed by them. He advises investors to maintain discipline and stick to their investment strategies during market ups and downs. Graham suggests that temporary market downturns can create opportunities to buy quality stocks at discounted prices. He cautions against attempting to time the market and encourages investors to focus on the long-term fundamentals of the companies they invest in. Chapter 9: Investing in Investment Funds. Graham discusses the benefits and drawbacks of investing in investment funds such as mutual funds and closed-end investment companies. He advises investors to thoroughly evaluate fund performance, expenses, and management expertise before making investment decisions. By selecting funds that align with their investment objectives and risk tolerance, investors can gain exposure to a diversified portfolio managed by professionals. Graham emphasizes the need to consider the costs and fees associated with investment funds, as they can significantly impact overall returns. Chapter 10: The Investor and His Advisors. Graham highlights the importance of establishing a trustworthy relationship with investment advisors. He advises investors to be cautious when seeking advice and to understand their own investment goals and risk tolerance. Graham emphasizes the need for transparency and alignment of interests between investors and advisors. He suggests considering the qualifications, track record, and fees of investment advisors before entrusting them with investment decisions. Chapter 11: Security Analysis for the Lay Investor, General Approach. Graham provides a simplified approach to security analysis for lay investors. He advises investors to understand a company's financial statements, evaluate its competitive position, and assess the management's track record. By analyzing key financial indicators such as revenue growth, profit margins, and return on equity, and conducting basic research on industry dynamics, investors can make informed investment decisions. Graham emphasizes the importance of avoiding overly complex investment strategies and focusing on a thorough understanding of the companies one invests in. Chapter 12: Things to Consider About Per-Share Earnings. Graham explores the limitations of relying solely on per-share earnings as a measure of a company's profitability. He advises investors to consider other factors alongside per-share earnings, such as earnings stability, growth prospects, and industry dynamics. Graham cautions against placing undue importance on short-term earnings fluctuations and emphasizes the need to evaluate a company's long-term earnings power. Chapter 13: A Comparison of 4 Listed Companies. Graham presents a comparative analysis of 4 listed companies to illustrate valuable investment lessons. By analyzing their financial statements, competitive positions, and management decisions, investors can gain insights into common investment pitfalls and opportunities. Graham provides examples of companies that experienced financial difficulties due to excessive debt, poor management decisions, or unfavorable industry conditions. He highlights the importance of evaluating a company's ability to generate consistent earnings and maintain a strong competitive position. Chapter 14: Stock Selection for the Defensive Investor. Graham offers practical guidance on stock selection for the defensive investor. He suggests using criteria such as earnings stability, dividend records, financial strength, and valuation measures to identify suitable stocks. Graham advises defensive investors to focus on well-established companies with a history of stable earnings and dividends. He emphasizes the importance of avoiding speculative stocks and relying on thorough analysis to make informed investment decisions. Chapter 15: Stock Selection for the Enterprising Investor. Graham explores stock selection for the enterprising investor, who has a more flexible approach. He suggests considering bargain issues, special situations, and unconventional investment opportunities. By conducting in-depth research, analyzing financial statements, and identifying opportunities that others might overlook, investors can capitalize on unique investment prospects. Graham provides examples of companies that may be undervalued due to temporary setbacks or market pessimism, which can present attractive opportunities for enterprising investors. Chapter 16: Convertible Issues and Warrants. Graham discusses convertible issues and warrants as investment options. He explains their features, advantages, and risks. Convertible issues are securities that can be converted into common stock, providing investors with potential upside if the underlying company performs well. Warrants are similar to options and can provide investors with the right to buy additional shares at a predetermined price. Graham advises investors to understand the terms and conditions of these securities, evaluate their potential returns, and decide whether to include them in their investment strategy. Chapter 17: 4 Extremely Instructive Case Histories. Graham presents 4 case histories of companies to provide valuable investment lessons. By analyzing their financial statements, competitive positions, and management decisions, investors can learn from past successes and failures. Graham highlights the importance of conducting thorough research and avoiding investments that carry excessive risks. He provides examples of companies that faced financial difficulties due to poor management decisions, industry disruptions, or excessive debt. By studying these case histories, investors can gain insights into the importance of careful analysis and disciplined investing. Chapter 18: A Comparison of 8 Pairs of Companies. Graham provides a comparative analysis of 8 pairs of companies to illustrate the significance of thorough analysis and intelligent stock selection. By comparing companies within the same industry and evaluating their financial strength, earnings stability, and market valuations, investors can identify undervalued stocks with growth potential. Graham emphasizes the importance of focusing on companies with competitive advantages, strong balance sheets, and attractive valuations. He provides examples of pairs of companies where one is fundamentally stronger than the other, allowing investors to discern the importance of fundamental analysis in stock selection. Chapter 19: Shareholders and Management's Dividend Policy. Graham explores the relationship between shareholders and management, focusing on dividend policy. He advises investors to consider a company's dividend history, payout ratio, and overall financial position when evaluating its investment potential. Graham explains that companies with a consistent dividend policy and a commitment to returning value to shareholders can be attractive investments. He provides examples of companies that have consistently increased their dividends over time, demonstrating their shareholder-friendly approach. Graham emphasizes the need for alignment between the interests of shareholders and management. Chapter 20: Margin of Safety as the Central Concept of Investment. In the final chapter, Graham introduces the concept of margin of safety as the central principle of intelligent investing. He advises investors to focus on buying securities that are priced significantly below their intrinsic value. By doing so, investors can minimize the risk of permanent capital loss. Graham explains that a margin of safety provides a buffer against unforeseen events or adverse market conditions. He suggests that investors should seek to protect their investments by purchasing stocks at a discount to their intrinsic value, reducing the potential for downside risk. The intelligent investor offers a wealth of knowledge for investors seeking to navigate the complex world of investing. By understanding the principles presented in this book, investors can make informed and intelligent investment decisions, increasing their chances of long-term financial success. Graham's emphasis on disciplined analysis, a margin of safety, and a long-term perspective serves as a valuable guide for investors looking to build wealth while minimizing risks. Thank you for watching. If you enjoyed what you just watched, please support us by liking and subscribing. Make sure to enable notifications so you'll be the first to know when we release new videos.